Does this make you less interested on the margins in buying 10-year or 20-year or 30-year treasuries?
Yeah, I've said in lots of different contexts with you guys that you have to just be careful about where you want to own your fixed income, that the yield curve move can be more important, more determinant to your fixed income returns than just the direction of interest rates. A lot of times we just think about you want to own bonds when rates are going down, when the Fed's cutting. You don't want to own bonds when they're hiking. But because the curve is so flat, we're off the peak of inversions, but it's still a historic lack of premium in that back end of the curve, that where you hold your duration is going to matter as much as how much duration you hold. So it's still that story for me. It's still the front end is a little bit better 5 years in. You want to be careful about that term premium. And the other thing that I'm highlighting here today is you just got to be careful about how much is already priced in. This is unique about the beginning of a Fed cutting cycle. We're about twice the amount of expected cuts priced at the onset. This was John Otter's article in Bloomberg. He highlighted this. It's a great chart. About twice the amount of historic Fed pricing, about over 200 basis points, whereas historically you come in and there's only about 100 basis points. So a lot is expected. It raises the bar for subsequent fixed income performance. We've had a great run, but that tells you a lot of the performance is in the rearview mirror. And so you got to be more thoughtful about where you own that duration around the curve when we look forward.
Does it give you more confidence, though, to go into risk, Jeff?
Well, I think the Fed did its best, and that was the interchange you just had with Dudley. The press conference challenge was give 50 without spooking the market. I think they're successful today in there. That's the response in terms of small caps. You only buy small caps when the Fed's cutting rates, when you believe in the soft landing and the denominator effect. The discount rate is dominating, any of your concerns in terms of growth. So I think they navigated that pretty well. I think when you go forward, it is a soft landing baseline. I think that's exactly what the SEP is saying. When you look at all of the other economic data outside of the labor market data, it's all very good. It's all very supportive for risky assets. And the fixed income side, that's a carry story. We're pretty comfortable with that. You got to be a little bit careful that it's asymmetric, that at very tight spreads, any sign of recession. And I don't think we're really seeing the recessionary signs out of the labor markets. But you have to be cognizant of it, that is the one place where you're seeing some weakness. But I think this is still supportive to risky assets.
Just quickly, Jeff, November 7th, how different is that committee meeting going to be compared to this one?
Well, as you pointed out, you're coming on the backside of the election, but as Powell answered, they're going to try to avoid any kind of discussion on that. It's really going to be about the evolution of the data. The interesting data point in terms of revisions. We talk about data dependence. The problem is the data we're dependent on is not very dependable. All right, try that out slowly. But that's the payroll data, right? And so the revisions are going to be important. We're going to have another one. That's going to dictate a lot of the discussion. Without a deceleration, I don't think you're going to be talking about 50s, but they've clearly laid the groundwork here for a 25 in November, 25 in December. That's what I think will price back into the bond market. That's why you're seeing a little bit higher rates. If they deliver on that, then there won't be as much surprise or anticipation as we had in this meeting.